Ind AS 115, which stands for Indian Accounting Standard 115, is a crucial framework that governs revenue recognition in India. This standard aims to enhance transparency and consistency in how companies recognize revenue from contracts with customers. The core principle of Ind AS 115 is that revenue should be recognized when control of the promised goods or services is transferred to the customer, reflecting the transfer of value. This principle fundamentally shifts the focus from risks and rewards to the transfer of control, which can significantly impact how revenue is reported on financial statements. To implement this standard, companies follow a five-step model. The first step involves identifying the contract with the customer. The second step is identifying the distinct performance obligations in the contract. The third step is determining the transaction price, which is the amount of consideration the company expects to receive. The fourth step is allocating the transaction price to the identified performance obligations based on their relative standalone selling prices. Finally, the fifth step is recognizing revenue when or as the entity satisfies a performance obligation, meaning when control of the good or service is transferred to the customer. In practical terms, identifying performance obligations can be challenging, especially in contracts with multiple deliverables. A performance obligation is considered distinct if the customer can benefit from the good or service on its own or together with other readily available resources. Conversely, a non-distinct performance obligation is one that is not separable from other promises in the contract. Determining the transaction price can also be complex, particularly when variable consideration is involved, such as discounts or performance bonuses. Companies must estimate the amount they expect to receive, taking into account historical data and market conditions. When there are multiple performance obligations, the transaction price must be allocated based on the standalone selling prices of each obligation. Control is a central concept in revenue recognition under Ind AS 115. It signifies the ability to direct the use of and obtain substantially all the remaining benefits from the asset. For example, in a construction contract, control is often transferred as construction progresses, allowing for the recognition of revenue over time. As we explore Ind AS 115 further, we'll delve into its implications for various industries, including construction, software, and telecommunications, and discuss how to transition from existing revenue recognition standards to this new framework. Now, let's transition into a question and answer format to help CA freshers prepare for interviews regarding Ind AS 115. 1. What is the core principle of Ind AS 115, and how does it impact revenue recognition? The core principle of Ind AS 115 is that revenue is recognized when control of a good or service is transferred to the customer. This impacts revenue recognition by shifting the focus from merely transferring risks and rewards to the actual transfer of control, leading to a more accurate reflection of a company's performance. 2. Can you explain the five-step model for revenue recognition under Ind AS 115? The five-step model includes 1. Identifying the contract with the customer. 2. Identifying the distinct performance obligations within the contract. 3. Determining the transaction price. 4. Allocating the transaction price to the performance obligations. 5. Recognizing revenue when control is transferred. 3. How do you identify a performance obligation under Ind AS 115? A performance obligation is identified based on whether the customer can benefit from the good or service on its own or with other readily available resources. If it meets this criterion, it is considered distinct. 4. What is the difference between a distinct and non-distinct performance obligation? A distinct performance obligation can be separately identified and provides value on its own, while a non-distinct performance obligation is tied to other obligations in a contract and does not provide standalone value. 5. How do you determine the transaction price under Ind AS 115? The transaction price is determined based on the amount of consideration the entity expects to receive, considering factors such as discounts, rebates, and other variable components. 6. Can you explain the concept of variable consideration and how it's accounted for under Ind AS 115? Variable consideration refers to amounts that are uncertain at the outset, such as performance bonuses or discounts. Under Ind AS 115, companies estimate this amount using either the expected value or the most likely amount approach, based on historical data and experience. 7. How do you allocate the transaction price to multiple performance obligations? The transaction price is allocated based on the relative standalone selling prices of each performance obligation. If standalone selling prices are not directly observable, they may need to be estimated. 8. What is the significance of control and revenue recognition under Ind AS 115? Control is significant because it determines when revenue is recognized. A company recognizes revenue when it transfers control of a good or service to the customer, indicating that the customer has the ability to direct the use of the asset and obtain its benefits. 9. Can you provide an example of a contract with a customer that has multiple performance obligations? An example would be a software company that sells a software license and provides installation and support services. Each of these services would be distinct performance obligations, and the transaction price would be allocated accordingly. 10. How do you account for contract costs under Ind AS 115? Contract costs, such as those incurred to obtain or fulfill a contract, are recognized as assets if they are expected to be recovered. These costs are amortized over the period of the contract. 11. Can you explain the disclosure requirements under Ind AS 115? Companies must disclose information about their revenue recognition policies, the nature of their performance obligations, the transaction price allocated to each obligation, and any significant estimates involved in revenue recognition. 12. How do you transition from existing revenue recognition standards to Ind AS 115? Transitioning involves assessing existing contracts, determining the impact of Ind AS 115 on revenue recognition practices, and possibly restating prior periods for comparative purposes. 13. Can you discuss the impact of Ind AS 115 on industries like construction, software, or telecom? In construction, revenue can be recognized over time as milestones are achieved. In software, revenue recognition may depend on whether the software is sold as a license or a subscription. In telecom, contracts often involve bundled services, requiring careful identification of performance obligations. 14. How do you handle contract modifications under Ind AS 115? Contract modifications are treated as separate contracts if they add distinct goods or services at a price that reflects their standalone selling prices. Otherwise, they are accounted for as part of the existing contract. 15. Can you explain the difference between Ind AS 115 and IFRS 15? Ind AS 115 is largely aligned with IFRS 15, but there may be specific differences in application and disclosure requirements due to local regulations and practices in India. By understanding these key concepts and preparing for these questions, CA freshers or accounts and finance professionals can navigate interviews with confidence, showcasing their knowledge of Ind AS 115 and its implications for revenue recognition in various industries. Thank you for watching. We have also created other technical interview questions, mostly focused on our finance profession. We encourage you to go through those videos as well, the links for which we have added in our description. Subscribe Finance Kida channel for more content like this.